Good morning from cloudy and frigid Chicago, where it is 5 degrees outside. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money bi-weekly podcast. Today's date is Sunday, January 25th, 2026. This extreme cold actually resulted in the cancellation of the annual Chicago Polar Bear Plunge that my sons Jack, Brett, and myself have been doing for charity as Asbury Research for the past several years. Thanks to all of you that have asked about this great cause or donated to it. Basically, what this club does is they choose 5 Chicago families every year that have had a personal disaster happen to them. And we raise money for them by jumping in Lake Michigan in the middle of January off of the Oak Street Beach in Chicago. And we raise money and it goes right to the families. There's no administrative cost. Everything is donated top to bottom. And so again, we're not going to have the plunge this year, but the three of us Kosars will be right back on the beach in Lake Michigan next January so we can participate again. Thanks again to all that showed interest in this. In today's podcast, which is why we're here, our focus is on the benchmark S&P 500, which we believe is in a precarious situation where it must either resume its April 2025 advance from right where the market is now within the next week or so, or we will likely begin a very overdue corrective decline. We have a lot of charts today that more specifically lay out the situation, and we're going to be looking at them in just a little bit later in the podcast. We're also paying attention to the recent rise that we have seen in long-term interest rates, even while the Fed is cutting short-term rates. This amid a decline to multi-year lows in the U.S. dollar index. At the least, I think this rise in long-term rates could be an indication of market expectations for upcoming inflation. But when you combine it with the decline in the dollar, it could mean declining global confidence in long-term U.S. interest rate policy, including central bank independence. We've seen quite a bit of relative outperformance. We have another metric that we look at that we've actually created. It's called U.S. versus the world. And 22 of the 25 or 23 of the 25 foreign equity markets that we track through this model are outperforming the S&P 500. So there's a lot going on globally. I think it might be connected. And with the S&P 500 up as much as 45% in about 9 months without a correction, when the next correction happens, and it will, it has the potential to be a really bad one. So I want to keep you on your toes and let you know that this isn't a fire drill unless our tactical models turn negative, and we have several of those. We have been in the market almost for the entirety of this move. We first got back in April 23rd, April 24th, and with the exception of just a couple of weeks, we've been in the market. But again, I'm kind of looking at the horizon here and putting everything into context, everything into consideration. The next correction we have could be particularly ugly. So again, we're going to look at some charts about that in just a few minutes. Before we get started, let me give you just a little bit of information about us. Asbury Research is a registered investment advisor, and we've been providing investment research to both individual investors and professional money managers since 2005, which makes this our 21st year in business. Most recently, we have created 4 model portfolios using our own in-house models like the correction protection model, or CPM as we call it, and our SEAF model, our sector rotation model, as building blocks, and we put these together for managed accounts. These portfolios have all been through a rigorous 8-year back test and have been trading in real time for the past 18 months by both individual investors and other money managers that are managing money for their clients. All of these are designed to protect, or all of these are designed to produce, I should say, S&P-like performance, but with significantly lower drawdowns and lower volatility. For those interested in research, we have 2 levels of research available. Our Asbury Premium is what we started the business on in 2005. It's for more serious investors. It includes updates on all of our models and also some one-on-one personal instruction that we do via Zoom on how to implement the models and strategies into your own portfolio. We also have our entry-level Substack newsletter. I'm going to put it up here right now just for a second. It's asburyresearch.substack.com, and it's entry level. It doesn't include updates on all of our models, but it includes various information throughout the week. We look at a lot of charts. We actually built a special model for this called the sort report. You can see that right there. It's basically a big filter to tell us quantitatively where the opportunities are in global investing. It's $25 a month for the paid service, and it also has a free version. So you can go right here, sign up for free. If you like our videos, if you like our approach to markets, I strongly suggest that you sign up for the free version of the Substack here. It's kind of a no-brainer. You can get a lot of free information, and you'll learn more about us and how we look at markets. Asbury Research is really a product of my 43 years in the business. Spent 17 years on the trading floor of the Chicago Mercantile Exchange back in the 80s and 90s. I've been doing this all my life. I'm really good at it. And we've moved away from the traditional RSIs and stochastics and MACDs. And we've actually built our own models. Everything is driven by numbers with very, very little discretion. So again, this is a good way to get to know us a little bit better. If you're an individual investor or you're a portfolio manager and would like to learn more about our services, reach out to us via the contact tab right here at asburyresearch.com. This is our premium service. There's a lot of information here that you can find out about it as well. Okay, so let's begin with the tactical condition of the market. And we're going to go to our research center. This is the paywall. And we're going to go to the Asbury 6. Most of you that follow me around the media have heard of the Asbury 6. The Asbury 6 is a quantitatively back-tested group of 6 disparate metrics that I use. I actually kept this in-house for a couple of years. I use this to keep me on the right side of the market, so I'm not chasing the tail of the S&P 500 as it's up 100 today and down 100 tomorrow. This really helps me. It's kind of a daily EKG of the stock market. We're looking at rate of change, relative performance between stocks and bonds, asset flows, volatility, trading volume, and market breadth, and together they keep me from biting on these herky-jerky movements that we get in the S&P 500, where it scares me out of the market, and then 3 days later, I'm chasing it to buy fresh highs. Again, daily driven gauge of the U.S. stock market's real internal health. The A6 averages about 10 round turns per year. So in other words, it's going to go from green to red, which is from positive to negative, and then from a negative back to positive. That's a round turn, about 10 of those a year. So it's really active. But the nice thing about it is it has stayed right on top of the S&P 500 for the past 8 years, and often is leading it by small amounts with a 60% lower maximum drawdown than the S&P 500. So it's active, but it keeps us on the right side of the market, and it keeps the drawdowns minuscule. I think the max drawdown during that 8 years was 16%, compared to 34% for the S&P 500. Right now, it has been 3 and 3 for 4 days in a row. So all of last week, 3 and 3. The previous signal had been positive, which why it's still positive. So when we go 3 and 3, which means the market's in balance, we retain the previous signal. If this turns to red or turns to negative, 4 or more of these constituents are going to turn negative. They're going to turn red here. That is going to be an indication to us that the market is starting to weaken. It's starting to weaken internally. Often when that happens, that's when the market starts to move lower. And considering, as I had mentioned earlier, that we're kind of at a technical balance point, what the A6 does here is really important. The next thing we're going to look at is our CEF model for sector rotation. So we're going to stay in the research center, but we're going to jump right here to the CEF model graphic. And so the CEF model is always in the market. It's created to be a dynamic market-driven alternative to the traditional buy and hold portion of a portfolio. Most people don't go all the way out of the market. They may be tactical for a portion of their portfolio, but some of that money stays in the market. This was meant to be a data-driven substitute for just blindly buying the S&P 1500 or whatever you may buy to kind of be plain vanilla in your portfolio. This is meant to replace that. What we've done is we've come up with an algorithm that measures the velocity of money that's moving around these 11 sector spiders, which if you put them together, it's the S&P 500. 3 different time frames: trading, tactical, and strategic. A week, a month, and a quarter. Let's just look at the trading here so we can understand how this works. The fastest money in over the past 5 days has been into financials, because that's why it has a number 1 rating. Second fastest money going in over the past five days, or over the past week rather, energy. Fastest money going out was number 1 technology, because it was 11 out of the 11 sectors. Second fastest money going out was in real estate. Then what we do is we add up these scores all the way across in the 3 time frames. So energy is number 1 this week in terms of the composite score, the ranking as we show here, with a 2 and a 1 and a 2, which if you add them up, it's 5. So the way the model works, we're always in the top 3. How do we know that? We've back tested this thing a lot. And we found that the best performance in the model is when we're always equally involved in the top 3. So the way we back tested it, we looked at a $100,000 hypothetical account, and we're always in the top 3. It's rebalanced weekly on the weekend. So if hypothetically next week financials drops out of the top 3, industrials moves into the top 3, that following Monday we will sell out of our financials and we will buy the industrials, and we'll still be a third, and then we're done for the week. So all we're doing is following the money, and of course we're staying away from the 2 or 3 down at the bottom. If you have an individual stock portfolio, you may be looking at what you're holding in technology and real estate, because the scores are quite bad for CEF. It means the money is coming out of there to go somewhere else. So since inception in mid-2018, CEF has significantly outperformed the S&P 500 on an annualized basis, but with a lower maximum drawdown. Standard deviation beta about the same as the S&P, but the drawdown's about 5% less, again with a better annualized performance with an 8-year look back, 7 to 8 year look back. Next thing we're going to do is, so far we're balanced in the Asbury 6, and the market is moving towards energy, healthcare, and financials, and moving away from utilities, real estate, and technology. The next thing we're going to do is we're going to go back to the research center. And we're going to open it up. And so here's all of our models in the Research Center. We have our CPM model, our CARP and US versus the world models. Here's CEIF, here's Asbury 6. ETF Trade Ideas we're going to get to just a minute. We'll give you some trade ideas. But our keys to this week is our weekly look at, Jack and I probably look at 150 charts, and we pick out 9 or 10 that we think are the most important to pay attention to and the most germane to what the market's doing now. So let's get into that report. And we're not going to look at every chart, but we're going to look at a lot of them. Chart number 1, S&P 500, just showing where the support is. Right now, 68.38 to 68.24 is what we call primary tactical support. This needs to hold next week in order to keep the uptrend intact, especially with the Asbury 6 at 3 and 3. It underscores that this is a balance point. If we can't hold this level, we're likely to go into a corrective phase, and that would be underscored by a move to negative in the Asbury 6. This is semiconductors. Last year, the primary driver in the stock market was the Mag 7 stocks. Mag 7 stocks have been underperforming since the end of last year. Semis have come up to take their place. So you can see down here, the SOX index, which is the Philips Semiconductor Index, has been outperforming SPY on a quarterly basis. This actually started back in June, but you could see the relative outperformance here. That's that horsepower that's coming in and taking over for the Mag 7. We also have a breakout higher here, just a technical breakout higher here, but we need to hold 73.93 in order to keep the breakout valid. If we can do that, we have another 6 to 7% on the upside, as our target here is 86. This is the Dow Transports. The Dow Transports are taking another run at breaking their November 2021 all-time high at 16,909. Transports is a very interesting one because if we could break out here in the transports, it indicates economic activity, the movement of goods. It's very good for the overall health of the market. So we're watching really closely to see. You can see we tried to break out here back in November of 24, got close to that area and rolled over. Let's see what happens here. I think it will give us some good information as to what market expectations are for the transportation of goods going into later in the first half of the year, certainly. Let's look at relative performance. This is relative performance between SPX and AGG, which is an aggregate bond index. Bonds typically underperform stocks. Stocks typically outperform bonds during a healthy bull market. So look what's happened here. On May the 8th, SPY started outperforming AGG. This is SPX up here, which is the cash index for the S&P 500. October 10th through 16th, it tested that 63-day moving average, which is our strategic time period. It's a business quarter. Tested it, held, nice bottom in SPX. It did it again on November the 20th, another nice bottom in SPX. Did it again in the middle of December, another nice bottom. We're right here again. It can't seem to get off that moving average. So we're really watching the relationship between stocks versus bonds next week, next couple of weeks, to see if it could hold this trend. If that trend breaks and stocks start underperforming bonds, that again would be characteristic of a market that's losing its mojo and maybe rolling over. Next, the VIX. This is a derivative of the VIX. It's the VXX, and it's a little bit smoother. It's based on futures, and it's something that we pay attention to. On November the 25th, the VIX dropped below its 21-day moving average, a business month. That's our tactical time period. And look what the coincident move in the S&P was. Last week, jumped up through the 21-day moving average for a couple days, which gave us this. This was the test of the 50-day moving average that we just looked at. So we're really watching this one closely next week. 2656 is where that 21-day moving average is through Friday. Vitally important for volatility to remain low if the S&P 500 is going to be able to recover from this dip that it had last week. Next thing we want to look at, I had mentioned rising long-term interest rates. This is TYX, which is a CBOE 30-year T-bond index. You could see we peaked in May of 2025, right around 5%. This 5% area, by the way, is a high extreme for the yield of the 30-year that goes all the way back to 2009. So big, important area here. Followed this trend line all the way down, but as of the middle of January, we have broken this trend, and it looks to me that we may be heading back towards another test of 5%. If we get there, it's a huge deal, because if we break it, if we get through 516 yield, that breaks that average, the extreme that we made back in 2009. And that could open the door for much, much higher long-term rates. So is this actionable right now? No, but looking across the horizon, you're seeing long-term interest rates rise even as the Fed is pushing the short-term down. It suggests to me that there may be some inflationary component to this, or maybe even because of all the turmoil in the geopolitical issues and what's coming out of Washington, tariffs today, no tariffs tomorrow. Are we going to have an independent Fed? We're fighting with all of our previous trading partners around the world. I don't know exactly what this is saying, but I'm keeping my eye on it. This is the dollar. This is UUP. This is the ETF that tracks the dollar. It's been bouncing around its February 2023 and January 2024 extreme lows for a while. It can't seem to get back off the dime, and look where we are now. If the dollar falls through this level, I'm going to guess that this is just not happenstance. This has to do with an event. And I think less confidence in the dollar, rising U.S. interest rates, they could be telling us a story that we need to pay attention to. So these are some charts here that I think are really important for us to watch here at Asbury for the next few weeks, and we think you should too. Next thing, part of our premium service is we have a model that scans 6,600 ETFs every morning. I get them first thing in the morning when I sit down at my desk at 5 a.m. and I look through those. They all meet characteristics in terms of having a positive price trend, and we have our own parameters. That's our secret sauce, but we have our own parameters that we look at, but they pertain to three things: positive price trends, relative outperformance versus the benchmark S&P. In our world, if it's not outperforming the S&P, then why should we buy it? You can just buy the S&P, or you can buy SPY, and you don't need us. So we're looking for outperformers versus the S&P 500. The third criteria is expanding asset flows in that particular ETF. It shows conviction, overnight conviction, in making the purchase of that ETF. The fourth one is the only one that is subjective, and my 17 years in the trading floor helps on this, but I tried to determine which of these that show up in our scan have the best risk reward potential. So we put those together. So the ones that we're currently involved in right now, we've been in gold miners since November the 26th. We've got a 31% lead, and we're outperforming the S&P by 30%. Incidentally, this is the second time this year that we've been in gold miners. We initially got into gold miners down here where are we? Here's our miners. right here, RING, on August the 6th. We exited the trade on 10/21 of last year for a 31% gain, while outperforming the S&P by 31%. Okay, so we're back in miners. We're also in telecom. Got a 2% lead there, outperforming the S&P by 2. We've got IWM, which is small cap, biotech. As we go up, these are newer. The dates move upward. We've got oil and gas, XES that we bought. We've got a 3% lead there, beating the S&P by 4%. And on Jan 15, we bought GSG, which is a commodity index. 5% lead, 5% outperformance versus the S&P 500. So you kind of see a theme here is a lot of the commodity markets are starting to do better. We've got oil. We have a broad commodity index. We've got miners, gold miners. We're also looking, we don't have it up here yet, but we're looking at base metals. So that's kind of this environment that we're in, is we're looking at potentially rising interest rates, possible inflation. The dollar looks vulnerable here. It's a big shift in, I think, really what we've been used to seeing. Here's why this works. Over the past 34 months of data, we had 120 trade ideas, about 4 per month. They're put out when the idea emerges and not based on the calendar. 54% of our trades are winners. Our average winning trade is 5.5%, which is more than double our average losing trade, which is only 2.4%. These are the components to a winning strategy for buying individual ETFs. More winners than losers, and your winners are significantly bigger than your losers. We also know that our average winning trade length in days is 20 days, 1 day shy of a business month. Our average losing trade length is 8 days, which is about a business week and a half. So this is how we even look at our individual picks. We want to go back, quantitatively determine if this is a good idea or not. So this is basically what we do so we can pick out stocks, or pick out ETFs rather. So our CPM model, our CEF model, ETF Trade Ideas, these are all a part of Asbury Research's premium research service, which is what you see here. Contact us using the contact tab right here at asburyresearch.com to request information about services details and pricing. Let's finally take a quick look at our Substack. I had mentioned that a little bit earlier. So here's our Substack. So we have 2 different components here. I think we're going to add another piece of research here as well. But right now, the sort report is put out 2 times a week. And what sort does is we've got a pretty wide swath of different investable things. We've got emerging markets, global equities ex-US, small cap, commodities, crude oil, interest rates, technology, dollar, and crypto. Then we look at them from 3 different lenses: trend, relative performance, and money flows. And the ones that have green all the way across means that it's clicking on all 3 cylinders, so to speak. This is very, very unusual for this many of them to be green. Interest rates, oil, commodities, small cap, global equities, gold, all outperforming. I had mentioned earlier that our US versus the world model, which we're not going to look at today, but it's part of our premium service, 22 or 23 out of the 25 non-US equity markets that we track are outperforming the S&P on both a monthly and a quarterly basis. It's a big deal. Something's going on here. There's a lot of unusual stuff we're seeing. Small cap. We haven't seen small cap do this well in some time. A lot of the commodity markets are also starting to pick up. We also have, as a part of this service, we have there we go. we've got a chart focus. This is once a week, and this is very similar to Keys to This Week. A lot of analysis, a lot of charts, a lot of strategy, a lot of understanding underlying conditions, what's going on across the globe. Both even interest rates, even the dollar. If there's something happening in those areas, we are talking about it and trying to put all of that into a broad format, so you have a very good, comprehensive understanding of what's happening in the market right now. So let's get back to asburyresearch.com. That wraps up our latest Asbury Research Following the Money podcast. Just a quick note, if I may, I will be getting interviewed this upcoming Wednesday, which is Jan 28th, right at the time of the NYSE market open, which is 8:30 here in Chicago, by CNBC Arabia. For those who like to follow us in the financial media. About a week later, I'll have a 30-minute interview by the Financial Sense website. If you've ever looked at Financial Sense, they interview everybody who's anybody on there. You have some really big-name people there. They've been in business for a long time. I've been getting interviewed by them for probably 10 years. The owner of the firm is the interviewer. His name is Jim Poplava. Always makes for interesting conversation. We're going to have a recording of both of these interviews. They're available free of charge at either asburyresearch.com or at our Substack, which again is asburyresearch.substack.com. Our next Following the Money is tentatively scheduled for Sunday, February the 8th. I hope to see you then. In the meantime, if you have any questions about what we're doing here or want more information on our research subscriptions or our managed account services, you can contact us again right here at the contact tab, asburyresearch.com. See you in 2 weeks. Stay warm and make sure you like and subscribe. Have a great Sunday.